Welcome to EduSmart. Today we are covering one of the most important and underreported topics in modern finance, the private equity liquidity crisis, and a new financial structure called the continuation vehicle. This is based on a report synthesizing data from Cass Business School, Lumonic, and Mark Sattin, all UK institutions, and it is directly relevant if you are studying finance, economics, or business. Let us break it down step by step. First, some background. Private equity, or PE, is when investment firms raise money from institutional investors like pension funds, university endowments, and insurance companies and use that money to buy private companies, improve them, and then sell them for a profit. In the UK, private equity is enormous. Firms like 3i, Bridgepoint, and Apax Partners have PE-backed businesses that employ hundreds of thousands of people. Historically, a PE fund would buy a company, hold it for 3 to 5 years, then exit through one of two routes, either an IPO, that is, listing the company on the London Stock Exchange, or a trade sale, meaning selling it to another company. Between 1998 and 2006, London saw 1,735 IPOs raising £70 billion, with PE-backed firms accounting for 22% of that volume. This was the golden era for PE exits. The model was simple and predictable. Then everything changed. Interest rates rose sharply from 2022 onwards in the UK. The Bank of England's base rate went from near zero to 5.25%. This froze the IPO market completely. Nobody wanted to list a company in a high-rate environment where valuations were compressed. Trade sales also dried up because buyers could not afford the debt-fueled acquisitions they once relied on. The result? A $3.8 trillion global backlog of unsold private equity assets, 32,000 companies worldwide trapped inside funds that cannot exit. The median holding period has stretched to 7.2 years, well beyond the original 3 to 5 year plan. And distributions back to investors, the actual cash returns, fell to less than 15% of net asset value for 4 consecutive years. In the UK specifically, 62% of all PE exits are now sponsor-to-sponsor deals, meaning one PE firm selling to another PE firm, simply because no other buyers exist. This is the liquidity drought. So what is the solution the industry invented? Meet the continuation vehicle, or CV. Instead of being forced into a bad exit, a general partner, that is the PE firm, can transfer its best assets from an aging fund into a brand new fund structure called a continuation vehicle. This gives existing investors a choice. Door 1, cash out at a negotiated price. Door 2, roll your existing stake into the new vehicle. Or Door 3, roll your stake and add fresh capital. The process takes 3 to 9 months of fresh due diligence, and the new vehicle typically runs for 5 or more additional years with fees of 50 to 100 basis points. Crucially, in the UK, the ICAEW, the Institute of Chartered Accountants, has confirmed that no minimum co-investment is strictly required for the carried interest tax qualification. That is important for UK-based fund managers structuring these deals. Continuation vehicles have exploded in scale. In 2018, they were a niche workaround. By 2025, the global CV market reached $100 billion in transaction volume, that is now equivalent to the entire global IPO market in size. They have grown eightfold in just 7 years. The secondary market, which is where CVs are bought and sold, is now dominated by enormous specialist funds. The 10 largest secondary platforms hold approximately $174 billion of capital. Ardian, the French firm with a major London presence, leads with over $30 billion. Collar Capital, which is actually a British firm founded in London, holds $17 billion. This has become a permanent infrastructure of the financial system, not a temporary fix. There are 3 main structures of continuation vehicles you need to understand. The single asset CV holds 53% of market value. This is where one premium company, called a trophy asset, is isolated into its own vehicle. The classic example is Vista Equity Partners' $5.6 billion cloud software group deal. The multi-asset CV holds 47% by value and bundles 2 to 5 companies from the same fund into one new vehicle. Then there is the emerging CV squared structure, where an asset gets rolled from one continuation vehicle into a second one. PAI Partners did this with Froneri, the ice cream company that owns the McVitie's biscuit brand, a very British business, rolling it twice. Each structure serves different purposes depending on the quality of the underlying assets. Now for the critical question: Are continuation vehicles actually delivering for investors? The data is mixed and important to understand. On pricing, 87% of CV deals are priced at 90% or more of net asset value, and 12% are actually priced at a premium above NAV. That sounds reassuring. But look at performance. The target return at underwriting is a 2.2 times multiple of invested capital, meaning investors hope to double their money. The actual realized median outcome so far? Just 1.4 times. That is a significant gap. Early evidence suggests these vehicles are struggling to deliver on their promises. There is also a conflict of interest problem. The GP is effectively selling to itself, setting its own price, and rolling its own carry forward. In 90% of deals, GPS rolled 100% of their available carry proceeds into the new vehicle, meaning they have a strong incentive to keep assets rather than distribute cash to investors. This conflict is why institutional investors are increasingly walking away. Public pension roll rates, meaning how often large institutions choose to roll their stakes into the new vehicle rather than take cash, fell from 14 to 30% in 2018 all the way down to under 5% by 2024. The CIO of the Alaska Permanent Fund described the situation as, quote, indicative of rot in private equity. CalSTRS, one of America's largest teacher pension funds with $390 billion under management, reports that managers are now offering 200 basis points above PE target returns just to persuade investors to take the cash option rather than roll. That tells you everything about the trust deficit in the system. The cracks are also showing structurally. Two major bankruptcies have tested the CV model in the past few years. Wheel Pros, a Clearlake Capital-backed company that was rolled into a continuation vehicle, went through Chapter 11 bankruptcy, wiping out $2.3 billion of CV equity. United Site Services, backed by Platinum Equity, generated $1.4 billion in combined creditor losses. And in December 2025, a landmark Delaware Chancery lawsuit, Addick vs. Energy and Minerals Group, directly challenged CV pricing practices. These are the first structural failure points of what was supposed to be a permanent solution. UK regulators at the FCA are watching closely, and there are growing calls for mandatory independent fairness opinions on all UK-based CV transactions. What does the future look like? By 2030, the secondary market is projected to reach $400 billion in annual volume. The base case assumes the $3.8 trillion backlog persists and repeat issuers claim over 60% of CV volume. In the bull case, CVS claim 25% of all private equity exits globally and megafund single-asset deals become routine. In the bear case, the ADIC legal ruling establishes LP standing to challenge pricing, which could fundamentally change the economics. For the UK specifically, with 62% of PE exits already sponsor-to-sponsor, the secondary market is not optional, it is the primary exit mechanism. UK finance students, this is the system you are entering. So what are the key takeaways? Private equity is facing a structural liquidity problem. The old exit model of IPOs and trade sales has broken down. Continuation vehicles are the industry's solution, now a $100 billion market growing at 8 times since 2018. But they carry real risks, conflicts of interest, a performance gap between targets and reality, and growing investor distrust. In the UK context, 62% of PE exits are now sponsor-to-sponsor. Collar Capital is a UK-based global leader in this space, and the AQ has issued specific guidance on UK tax treatment. Whether you are planning a career in investment banking, private equity, fund management, or accounting, understanding how capital gets recycled through these structures is now an essential skill. That is your EduSmart deep dive for today. Subscribe for more finance and AI content, and we will see you tomorrow.